Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors entitled Breaking Down the New Tax Bill. I want to thank you for joining us for our latest presentation. My name is Dan, the moderator for the webcast. Today's presenters are Jim Holtzman, CEO and President, and Bill Knight, Wealth Advisor at Legend Financial Advisors. Please hold as I turn it over to Jim and Bill.
Great. Thank you, everybody, for joining us today. So the first thing we'll cover is you'll hear or see the acronym OBBBA, and what that stands for is the One Big Beautiful Bill Act. So it's a little bit of a mouthful, but you'll see both of those, they're interchangeable. It was signed into law on July 4th, 2025. And just kind of at a high level, a lot of the provisions in this bill kind of extend or build off of the Tax Cuts and Jobs Act from several years ago. And it builds off of that. There's some provisions that are made permanent, some are still temporary, and there's a bunch of new rules as well. What we tried to do pulling this presentation together, we're not going to cover every provision within the bill, but we tried to pick the ones we felt would be most commonly used, or at least garner the most attention. And hopefully we won't get into the rest of the provisions because it's quite lengthy, many thousands of pages. So with that, we're going to go over some commonly used terms on the next slide. And throughout the presentation, we're going to be talking about different tax terms. The two that will be brought up the most will be AGI, which stands for adjusted gross income, and that's a line item on your tax return. And it basically takes your income minus certain what we call above the line deductions, and then that's how you get to AGI. MAGI, which is modified adjusted gross income, there's a few tweaks that are made to adjusted gross income, but for the most part, oftentimes these amounts will be the same or very close to being the same amount. So as we go through the presentation, we may reference just the acronym, and so we wanted to at least give a brief explanation of what those are. So one of the big items that came through in this bill is that with the income tax brackets that were reduced as part of the Tax Cuts and Jobs Act, this new bill has made those brackets permanent. Of course, everything's always subject to change, but if they weren't made permanent, then pretty much every tax bracket would have gone back a couple of percentage points approximately to where we were before the Tax Cuts and Jobs Act was put into place. On our next slide, one of the items that was addressed was an increase in the standard deduction. And so the way to read this the first column for 2025 is where things were under the Tax Cut and Jobs Act. And then the second column for 2025, the OBBBA column, is where things are changing to because of this new bill. And you can see for single, there's been an increase for this year from $15,000 to $15,750. Head of household increased from $22,500 to $23,625. And then married filing jointly increased from $30,000 to $31,500. And so when you're looking at your standard deduction, this is where you compare your standard deduction to your itemized deductions, and then you're able to write off the greater of the two. So these numbers have increased significantly over the last two tax laws that have been passed.
All right. Now, one of the new items that was introduced from the OBBA is the Enhanced Standard Senior Deduction. So this is one of the items that is new. And what's interesting about this is it's for individuals ages 65 and over, and they have the ability to claim an additional deduction of $6,000. So that is if you are filing single, and it would be $12,000 for joint filers. Now, that's something that is in addition to the standard deduction that Jim had just mentioned. Now, this is a temporary addition, so this is for 2025 through 2028. And one of the nice parts about this is actually in addition to the current additional standard deduction for seniors, which is $1,600 or $2,000 if unmarried and not a surviving spouse. So what this looks like from a visual representation is we have this illustration, and this is from kitses.com, and they did a nice job of laying out what this would look like for if you are filing single here, if you are married filing jointly, that's what MFJ stands for. And this particular column would be if you are have one spouse age 65 plus, and then the third column would be for, again, married filing jointly, and if both spouses are age 65 and over. So the way this is set up is it has the dollar amount on the left-hand side, and it identifies the different deductions. So the one that Jim was mentioning earlier, so let's focus on the single filers. The deduction went up to $15,750, and then on top of that, seniors age 65 plus and also for the blind have an additional $2,000 deduction. And then new for this year is the additional $6,000 deduction. So the total amount is $23,750. And then you can see the respective amounts if you are filing jointly. So if one of the spouses is age over 65, you have that benefit of using the additional $6,000. So the total is $39,100. And then if both spouses are filing jointly, both age 65 plus, you would have the ability to both use the $6,000 deduction for a total of $12,000, making up a total deduction of $46,700. So it's certainly a nice added benefit from this new tax bill. And one of the considerations for this is that there is a phase out range when looking at this $6,000 deduction. So if you are filing single, that range starts at $75,000 for having your modified adjusted gross income. And then if you are filing jointly, the modified adjusted gross income would be $150,000 in terms of where that phase out starts to begin. So that's one consideration to keep in mind. Now, the next part we're going to talk about is the child tax credit increase. So with the child tax credit, that has been around for about 3 decades now. And if the sunset were to occur and there was no update in the tax bill, it would have decreased from $2,000 to $1,000 per child. With the new tax act, it permanently increases the credit to $2,200, and this is beginning this year in 2025. And one of the main updates that they made for this, and kind of one of the big changes for this child tax credit, is that it is now indexed to inflation, and that will be starting in 2026. So certainly a nice benefit for families. And one of the other items that is a new item for the Tax Act is the Trump accounts. Now, with the Trump accounts, this is new, and it's a type of IRA or individual retirement account, and it is specific for minors. So it can be funded from birth up until age 18. And the contribution limit for the first year will be $5,000. And one of the interesting parts about this is that you'll be able to start making contributions for these Trump accounts in July of 2026. And they will be indexed for inflation in terms of the amount that you can contribute on an annual basis. So that will be one of the similarities when comparing this to other IRAs, such as a traditional IRA or a Roth IRA. One of the differences is that there's no earned income requirement. So that is different when you're looking at different ways to fund accounts and help for saving for your kids, is that if you were to use a traditional IRA or a Roth IRA, the child would have to have earned income to be able to make those contributions. So one of the nice benefits of these accounts is that that is no longer a requirement. Now, contributions made to the Trump accounts are not tax deductible, so that would be one of the differences when comparing this to something like the traditional IRA, for example. And another feature is that charitable organizations, in particular qualified charitable organizations, 501c3, can contribute on the beneficiary's behalf, and that actually does not count towards the $5,000 limit. One other type of contribution that can be made to the Trump accounts is actually from your employer, and that would be a contribution limit up to $2,500 per year, and that particular contribution would count towards the annual limit of $5,000. Now from there, we're going to get into another one of the differences when comparing this to a traditional IRA or a Roth IRA, or even something like a 529 plan for kids. And that is regarding the investments that you're able to utilize in the Trump accounts. So it says here that investments are limited to index funds that track US markets. And a good example of this would be something like the S&P 500. So that would be a domestic index tracking the top 500 companies in the US markets. And additional information that they have provided so far is that the management fees would have to be less than 0.1%. And they also made a note that you will not have the ability to use any alternative investments such as a sector fund. So for example, if you wanted to invest in copper, for example, or an investment like semiconductors, you wouldn't have that ability in something like a Trump account. Whereas typically with a traditional IRA, a Roth IRA, you would have a much more broad universe of investment options to choose from. In addition to that, there are no withdrawals allowed until age 18. And then at age 18, the account automatically converts to a traditional IRA and would assume the rules of a traditional IRA at that point. And then lastly, what's nice about this is there's a one-time $1,000 jumpstart contribution from the federal government. And this will be for children born between 2025 and 2028.
Okay, so now we're going to talk about probably one of the more popular provisions, just because of its name, is the what's called the SALT cap. So what exactly is that? The SALT cap stands for state and local income and property tax deduction. So back when the Tax Cuts and Jobs Act was passed, they capped the amount of state and local income taxes and property taxes to $10,000. And what they have done with the new bill is they have increased this to $40,000. So quite a jump. There was just a lot of discussion about where exactly this would land, and they came out to $40,000. So what will happen from there is that every year, that amount, the $40,000 amount, will increase 1% each year through the year 2030. Then in 2030, the cap goes back to the $10,000 deduction amount. Now, of course, between now and then, it could get extended, but this is the way it is set up currently. Now, of course, there's going to be some income limitations for this. So on this chart, we listed out the years and the amount of the self-deduction limit in the second column, and you can see it starts out at 40,000, then has the subsequent 1% increase, and then in 2030 it drops back to 10,000. So in the final column, the MAGI, so again, that's modified adjusted gross income, this is the range for where this deduction will get phased out. So you can see, just for example, in 2025, once you reach 500,000 of MAGI, this deduction will start to get phased out, and then it is completely phased out when you get to $600,000. So some pretty big numbers there, but it's important to be aware of that. And then that also gets inflated, and you can see what those look like over the next several years. And then in 2030, there is no MAGI phase out, as there wasn't before as well when it went back to $10,000. So next we're going to talk about some additional itemized deductions, but for this one, this is for charitable deductions, and this will actually apply to non-itemizers. So a handful of years ago, there was the same deduction in place. It was $300, I believe, for single individuals, $600 for married filing joint. So what's happening is that, and that went away for a couple of years, and now it is coming back. So it is going to start up in the year 2026. As it was before, it's an above the line deduction. So once you have the right amount of charitable contributions, you're not going to lose anything due to phase outs and things like that, at least in terms of not being an itemized deduction. And then the benefit is going to be that if you're not itemizing, you at least can have some ability to write off some of your charitable contributions. So the deduction limits are up to $1,000 for single, and MFS stands for married filing separately, and up to $2,000 for married filing jointly. Excuse me. So next, keeping in the theme of charitable deductions, we're going to talk about some changes for the itemized deductions. And so what's happening here, and this will start in the beginning of 2026, is that they put a kind of another floor you have to exceed before charitable contributions can count towards your itemized deductions. And so the way that'll work is that you have to have charitable deductions, contributions that exceed 0.5% of your AGI, or adjusted gross income. So put an example in here. So if a person's AGI for 2026 is $100,000, the first $500 of charitable donations will not be deductible. And so that 500 amount was taken just by taking the $100,000 amount times 0.5%. So in addition to that, there has always been different rules in terms of AGI percentage limits on cash contributions. This isn't a big change. So with the prior rule, the cash contributions to a public charity were limited to 60% of AGI. That was going to expire at the end of this year and go back to 50%. They've now made the 60% number permanent. So not a big change there, but still one to be noted of. And if your contributions exceed that amount, there is a carryover for charitable contributions in the future years that can be used. So for a new change on charitable deductions, and this will only apply to being in the very top federal income tax bracket, and this will be new for 2026. So for taxpayers in the 35 or 37% bracket, your charitable contribution deduction will be calculated using the 35% rate. So even if your income is in the 37% bracket, your charitable contributions will be calculated using a 35% rate. So not a huge change, but again, just some items to be aware of with the charitable contribution rules.
All right, so now on to the auto loan interest and having no tax on auto loan interest. So this is going to apply for those of you who are considering a new vehicle purchase. And the way that this works is it is a below the line deduction, and it can be taken whether you are itemizing your deductions or whether you are using the standard deduction. So in terms of eligibility, the way that they have set this up is the intended use is for personal use vehicles. So it's new cars, vans, SUVs, pickup trucks, and motorcycles. And the idea is it's not for ATVs, for example, something that's an off-road vehicle. It's something is to be operated on the public roads. And one of the big items about this is the vehicle must be assembled in the US. So if you are curious as to, whether or not the vehicle you're looking at is assembled in the US, a simple check of the vehicle identification number, the VIN number, will help you identify whether or not it was assembled in the US and whether or not you would be eligible for this no tax on auto loan interest. And one other way to be able to access this benefit is if you have an existing loan on a vehicle and you refinance it in 2025, the interest on the refinanced loan would still qualify for this benefit. So that would be something else to consider if you already have a pre-existing loan outstanding. And then one other item to consider for this is that there is a cap on the deductible interest of $10,000 per year. And there is also a phase out range when it comes to this as well. So the phase out range begins when modified adjusted gross income would be $100,000 for single filers and $200,000 for joint filers. And then it would essentially be phased out and you will not be eligible for this if, as a single filer, your modified adjusted gross income was $149,000 and then $249,000 for joint filers. Now on to the lifetime gift and estate tax. So one of the big conversations over the past several years in terms of the potential sunset that would have occurred at the end of this year was what was going to happen with the gift and estate tax. And, prior to that, it was set to expire after 2025. And if Congress had not acted, the exemption amount would have reverted back to its pre-Tax Cuts and Jobs Act level, which is basically 2017, of $5 million per person. And for perspective, where it was at this year was 13.99 million. And this is basically the amount that you can pass on and not have to pay the federal estate tax, which can be up to 40%. So this is certainly an important topic when it comes to estate planning when you have your overall net worth above and beyond these levels. So what this act does is it raises the exemption amount to 15 million per individual, which is 30 million for married couples. So certainly it's a relief in terms of estate planning for families that have a net worth over those amounts.
Okay, so we're going to talk about another pretty popular provision for the overtime pay deduction. And so the way this is going to work is that for married filing jointly, there is going to be a deduction available up to $25,000. And for any other filers, single, married filing separately, the deduction limit is going to be $12,500. So on top of that, or with that, there will be phase outs for this. And so for single head of household, this deduction will start to phase out once your modified AGI reaches $150,000. For those married filing joint, the phase out begins at $300,000 of modified AGI. So a couple of eligibility requirements for this is that the employee must be a non-exempt W-2 employee. The overtime must meet federal labor standards. Independent contractors are not eligible. So that's if you're self-employed, you file a Schedule C, this does not apply to you. And then on your W-2, it must reflect the overtime pay. Just be kind of a separate line item, making it really clear what that amount is. So the way this will work is that this overtime pay deduction is going to be below the line, which means it'll be taken after adjusted gross income. And one thing that really hasn't been talked about too much is that Social Security and Medicare taxes will still apply. So the Social Security 6.2% and Medicare at 1.45% are still going to apply to overtime pay. So kind of related to this is going to be the next slide where we talk about the qualified tips deduction. So kind of very, very similar in the way it'll work compared to the overtime pay deduction. So this will be a deduction up to $25,000 of qualified tip income, and that's for all types of filing statuses. It will be effective from starting this year through 2028, and the tips will still remain subject to payroll tax. It will be included in AGI, and it may also be subject to state income tax. So a little more information on the eligibility requirements is that the occupation must, as the IRS says, traditionally and customarily receive tips. They're going to give more information on this in probably about a month. The tips must be voluntary and determined by the payer, not mandated service charges like you see sometimes at restaurants. There excludes tips earned from basically from service providers like lawyers, accountants, and financial advisors. And then the deduction is also below the line, again, taken after adjusted gross income. There's also a phase out for this, the same as the overtime phase out. So you can see it's $150,000. The phase out starts at modified adjusted gross income for single and head of household, and then $300,000 modified AGI for married filing joint. And so for business owners, the deduction is limited to your net income from your tip-related trade or business. So another way to put it is you can't just have a net loss caused by the qualified tips deduction. And then on the next slide is just a chart kind of summarizing the last two concepts, the qualified tips deduction and the qualified overtime deduction, and kind of laying it out this way. You can see they're almost identical. The one exception is for the filing statuses. So qualified tips, again, is the $25,000 for all filing statuses. And then there's a little bit of a difference for the qualified overtime deduction, $12,500 for single and head of household, and $25,000 for married filing joint. Otherwise, the way these will work are basically the same. Now we're going to dive into section 529, the education accounts. So there's been several changes made to this, primarily around the eligible expenses. And so with the 529 plans, these are the vehicles that are set up. Every state pretty much has one with not multiple plans. And if they're used for education, you are able to withdraw the funds along with the earnings tax-free. So they've, over the last 20-some years since the 529 plans really became popular, there have been tweaks made to the plans, basically allowing more flexibility for how they will be used. And this is no different. So the additional eligible expenses are going to include curriculum material, textbooks, instructional and online learning materials, any tutoring. And you can see it would be outside the home by qualified or unrelated tutors, so family member can't do the tutoring and have a withdrawal come out tax-free. Standardized tests, AP exams, college admission exam fees, the 529s can be used for those now tax-free. Dual enrollment fees, and that's college courses taken during high school, and educational therapy for students with disabilities. So on the next slide, we'll talk about some other updates surrounding these type of expenses. So the annual expense limit has increased from $10,000 to $20,000 per year for these. A retroactive reimbursement rule was also put into place, and that's for expenses incurred before or after the enactment of this law may be reimbursed if the distribution occurred in the same year. All right, so on the second part of this has been, again, kind of expanding the usage of these. So this is for post-secondary credentialing expenses. So expenses that can be covered with this are going to be for tuition fees, books, and other required costs for the enrollment in that program. The exam fees, if any, are required to obtain or maintain a credential, and continuing education fees necessary to maintain a credential. So you see it just continues to expand in terms of its usage. And then for continuing on with the post-secondary credential expenses, so some other items are industry recognized credentials accredited by major credentialing organizations, apprenticeships registered with the U.S. Department of Labor, occupational licenses issued or recognized by a state or the federal government, and then other post-secondary credentials defined under Section 3 of the Workforce Innovation and Opportunity Act. And no, I did not include that information on the presentation. But I think you just kind of see the general theme has been the continued expansion of the usage of 529 plans. I think what's happening is they're realizing, Congress is realizing that there's just, the education system is changing, apprenticeships are happening more often, so they want to continue the 529 plan concept to just expand it and make those benefits available to more people. Okay, then the last topic we're going to go through are some changes with tax credits. So, and there's more than what I'm even going to show here. These are just maybe some of the more popular ones. So for the first slide related to this is going to apply to clean vehicle tax credits. So these are going to terminate September 30th of this year. And so those apply to the following credits. There's a previously owned clean vehicle credit. There is a clean vehicle credit, and there's a credit for qualified commercial clean vehicles. So these go away in 20 days. The next slide, we're going to talk about energy and efficiency tax incentives, and these have already basically gone away. So these were effective June 30th, 2026, even though the bill was passed on July 4th, or for 26, the bill, not this year, but next year, the termination of the following credits will apply. The alternative fuel vehicle refueling property credit, the new energy efficient home credit for homes acquired after June 30th of 2026, and then the energy efficient commercial buildings deduction will be no longer available for property beginning its construction after June 30th of next year. And then the final slide touches on energy and clean energy credits. So these are going to end December 31, 2025. So that is the energy efficient home improvement credit, the residential clean energy credit. And then there are wind and solar projects also part of the credits. So these must begin construction by July 4th, 2026, or be placed in service by the end of 2027. So I think the main thing is you kind of see what the theme on these is that they're all going to be going away unless something changes with the law and the rules pertaining to that. So like I said, there is a number of other credits covered. Some of these are just not used as much, but it was a pretty large part of this was dealing with the various tax credits. So with that, we are ready for some questions and answers.
Okay, to start off, one of the questions that we received, it says, please discuss changes to the federal health insurance premium tax credit. So if you're not familiar with it, the federal health insurance premium tax credit was something that is designed to help individuals afford health insurance who don't have access to either an employer plan where they can essentially have a subsidized way to access health insurance, or to use something like Medicaid to have a more attractive rate. So what had happened after COVID is that the federal government had removed some of the income limitations for the individuals who can still access this credit. So for this year, for example, they were more generous with those limitations. So the limitation for this year is they are open to having people access this credit if their income is over 400% of the federal poverty level. And what is going to occur in terms of the changes with the recent tax bill is they are going to remove that, and you will only be eligible to access this credit if you have an income that is up to, not exceeding, 400% of the federal poverty level. And just for some brief perspective, when it comes to the federal poverty level and those numbers, so the level for a household of one person is 15,650. And then what they do for each additional person in the household, they would add $5,500. So just for an example, if you were a household of two people, the federal poverty level would be 21,150. And then looking at 400% of that amount, you would have $84,600. So you wouldn't be able to exceed that income level and still have access to this health insurance premium tax credit. So that's one of the changes for this. And then over the next few years, they're also reducing the overall amount of people that have ability to access this credit. So they're making sure it's via permanent residence in 2027 is one of the other changes.
Great. Another question that came through is having to do with the SALT, the state and local income tax and property tax write-off, is will that deduction of $40,000 be available for 2025? And it is. It starts for this year. So the full write-off will apply if you have that amount of expenses. That'll be the cap for this year.
One of the other questions that we received was regarding Social Security changes, and were there any changes for Social Security? So specifically to Social Security, there were not any changes. What was commonly referenced and kind of tied to Social Security was the additional senior deduction, which we talked about earlier, and that was that $6,000 amount. So it's something that when the federal government did their calculations, they expected that about 88% of people with this new additional standard deduction of $6,000 per person for those age 65 and over, that it would cover the amount of your Social Security that would actually be taxed. So that's kind of why it was tied to Social Security, but specific changes to Social Security, there were not any.
Okay, so the next question is, for someone turning 65 in 2026, will the $6,000 increase in the standard deduction be effective for the whole tax year, for only part of the year which they were 65 years old. So the way that will work is that as long as you turn 65 in 2026, the entire $6,000 increase will be effective. So it won't be prorated based on when you turned age 65. So it'll be there for the full year.
Okay, and the next question we have is, can we assume that all of these deductions will be accurately explained in the IRS instructions for the 2025 tax year?
That's a great question.
That is the question. You know, I think at least from the information that we're finding, it seems that there continues to be more accurate information and also some information that we're still waiting on the specifics for. For example, there's a few items, for example, with the Trump accounts that in terms of the logistics and how it will work, we're still waiting on some information. But I would say there will at least be instructions there to use. How accurate they are may be up to maybe subjective.
And typically after these kind of big tax laws go through, the IRS will follow up with what they call regulations, where they clarify more of this. There will be a lot of questions that come in, and they'll try to address those. You would think all of the instructions would be properly updated. The tax forms have to be updated as well. There's quite a few things that will change how the tax forms look. And relative to some other prior tax laws that were passed, this one was done pretty early. There were times where tax bills were passed in December, and the IRS had to scramble and get the tax forms updated and the instructions for the forms, the various publications that they do, and it was a mad scramble. So this, at least there's more of a runway in terms of getting everything implemented. So hopefully that won't be a problem for the 2025 year. So wait and see if there's any other questions that come through. But I think, with a number of these changes, depending on your situation, some level of planning could be in order to determine how to take advantage of these. There's two components that I look at with this. One is a planning component, and trying to juggle where your income falls, because a lot of these things we covered and a lot of rules that are already in place are income based, where you maybe lose the benefit, it gets phased out, or you just don't qualify for the benefit. And so doing planning, if you're close to any of these thresholds, doing some planning during the year certainly makes sense, because there may be decisions you can make during the year to reduce your income so that you qualify for some of these, or at least partially qualify. And so that can be everything from capital loss planning, if you have a lot of capital gains, tax loss harvesting as it's called. There are other ways you can try to reduce your income. If you're working, you can maybe increase 401k contributions. That can drive your income down. There's a number of things you can do, but there's so many moving pieces. You kind of plan to take advantage of one provision, and then maybe it throws off another tax benefit you were going to get. So you just have to be careful with it. The best way to do it is, running through projections, which we do for our clients. We'll run income tax projections to make sure that at least the opportunities are understood and what the consequences are based on whatever decision you're making that affects your taxable income. And then, the second part of this is, some of these changes will apply for everybody, and just the projections can help at least show where you're going to stand at the end of the year in terms of whether you owe money or not owe money, lessen the surprise, plan for getting the money aside to pay for the bill. So there's, two parts of this. One is the planning part done throughout the year, and then at the end of the year, updating everything to see where you stand for the year as well. So we help our clients with that. We work with our clients' accountants to make sure they're on the same page as well, especially if there's some big decisions that need to be made, maybe before year end or throughout the year. Well, it looks like we are done with questions. So we will turn it back over to Dan, but we really appreciate everybody taking the time to attend the webcast today.
Okay, great.
Thanks, everyone.
Thank you, Jim and Bill. A lot of great information we covered today. And I want to thank everybody for joining us for the webcast. If you'd like to schedule a free conference call consultation with a member of our advisory team, I have placed Calendly links in the webinar chat for meetings with Jim as well as meetings with Bill. Alternatively, you can call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and everybody have a great day.